Ladies and gentlemen, good day and welcome to the Q3 FY’25 earnings conference call of Vijaya Diagnostic Centre Limited, hosted by JM Financial. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Raghav Vedanarayanan from JM Financial. Thank you, and over to you, sir.
Thank you, Darwin. Good evening, everyone. I, Raghav Vedanarayanan, on behalf of JM Financial, welcome you all to the Q3 FY’25 earnings conference call of Vijaya Diagnostic Centre. At the outset, I'd like to thank the management of Vijaya for giving us this opportunity to host the call. I'm looking forward to having an insightful interaction on the quarterly earnings and the outlook here onwards. Today from the company, we have Ms. Suprita Reddy, Managing Director and CEO, Mr. Narasimha Raju, Chief Financial Officer, Mr. Sivarama Raju, Vice President Operations, and Mr. Dhiren Gala, Assistant General Manager, Investor Relations. I now hand over the call to the management for their opening remarks. Over to you.
Thank you, Raghav, for hosting the call. Good evening and a very warm welcome to everyone. I will begin by sharing the key highlights for the period, after which we will take you through the operational and the financial highlights for the quarter ended 31st December 2024. I'm pleased to begin my address on a positive note, highlighting that we have delivered an impressive growth, achieving a remarkable 27% year-on-year revenue growth, out of which 20% is driven organically through volumes across both the radiology and the pathology segments. This accomplishment is a result of the strong performance of our new centers as well as the dense network that we have built successfully over the years in our core geography. Our Tirupati Center, a 2-year-old hub center in our core geography of Andhra, has been performing exceptionally well since its inception. Building on its success, we have recently installed and upgraded this facility with a PET-CT machine in response to the growing healthcare infrastructure and enhanced oncology treatment capabilities in this region. We anticipate that the demand will gradually increase over time, supported by the catchment area of neighboring districts. I'm also delighted to announce the launch of our first spoke center in Pune at Pinkley Saudagar under the Vijaya PH brand name, following the acquisition of PH Diagnostics. Looking ahead, I'm excited to announce that we will be commissioning 6 new hubs across Pune, West Bengal, and Bengaluru over the next 3 months. This will bring our total hub additions to 9 over the 12-month period, marking a significant milestone in Vijaya's history. To be precise, we will be launching 2 hubs in each of Pune, Bengaluru, and West Bengal regions, and additionally, we have also finalized 3 more leases for hubs in West Bengal, which will be set up in the next 3 to 6 months to come. To drive the next phase of growth, we have strengthened our leadership team by promoting both internal talent and also making key lateral hires. Since talent is the key to our success, we will continue to expand our team by bringing in both strategic resources in information technology as well as other key business and support functions to further enhance our capabilities. As you all are aware, in the past 2 years, we have made significant investments in IT to improve customer experience and engagement, as well as to boost business efficiency. I'm happy to share that these systems are now stable, and we plan to continue investing in additional technologies and also the CRM in the near future to further enhance our experience and operational efficiency. In conclusion, I would like to highlight that with a combination of strategic hires and a very focused expansion strategy, we are very confident in our ability to replicate the success of building a dense network beyond our core geography, positioning us to capitalize on the growing demand in this diagnostic sector. With this, I'd like to hand over to Raju to take you through the operational and the financial highlights.
Thank you, madam. Good evening and a warm welcome to everyone. I will quickly take you through the financial performance and key developments for the current quarter and 9 months ended December 31st, 2024. The consolidated revenue for the current quarter stood at 169 crore, reflecting a strong revenue growth rate of 27% year-on-year. And this strong revenue growth, just like the previous quarters, was driven by test volume growth of 27% year-on-year. Our patient footfall also grew by 19% year-on-year. I am delighted to inform that the year-on-year organic business, excluding PH Pune, grew at an impressive 20% year-on-year growth rate, with entire such growth attributed to the test volume growth of 20% year-on-year. Coming to PH Pune's performance for the current quarter, the revenue stood at 11 crores, which is broadly in line with our expectations of annual run rate of around 47 crores. Coming to the geography-wise revenue contribution, Hyderabad contributed 72%, rest of AP Telangana contributed 18%, and Pune contributed 6%. Like the previous quarters, the revenue growth has been driven by both radiology and pathology segments, reflecting the robustness of our B2C focused integrated business model. The B2C revenue stood healthy at 93%. Our radiology business stood at 37%. The revenue per test was 460 rupees and the revenue per patient footfall was 1616 rupees during this current quarter. EBITDA for the current quarter stood at 67 crore as compared to 52 crore in the corresponding quarter in the previous year, reflecting a year-on-year growth rate of 28% in line with the revenue growth. Excluding PH Pune, the EBITDA year-on-year grew by 22%, again slightly higher than the revenue growth. The EBITDA margin stood healthy at 39.7% in the current quarter, with an improvement of 30 basis points year-on-year. The profit after tax for the current quarter stood at 35 crores, reflecting a growth of 36%, and PAT margin also stood healthy at 21%. I will now summarize our performance for the 9 months period ended December 31st, 2024. The consolidated revenue for the current 9-month period stood at 508 crores as against 393 crores in the corresponding previous year, reflecting a year-on-year growth rate of 29%, with 21% growth being organic contribution. EBITDA stood at 204 crores as against 158 crores in 9 months of last year, registering a year-on-year growth rate of 30%. EBITDA margin stood healthy at 40.2%, and profit after tax, PAT was 108 crores with a margin of 21%. Coming to the update on the capital investment, 3 hub centers have already been commissioned in the 9 months period ended December 2024. Now the company is on track of commissioning 9 more new hub centers in the next 6 months. Hence, we foresee a slight impact on the existing EBITDA margins in the near term. However, this is expected to normalize once the business ramps up across these new hub centers. To conclude, I would like to state that we continue to hold a position as the largest B2C integrated diagnostic chain with strong brand recall and comprehensive test portfolio, supported by healthy balance sheet and industry-leading margins and interest-to-return ratio. That's all from my side. I will ask the moderator to open the line for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. We have the first question from the line of Sumit Gupta from Centrum. Please go ahead.
Hi, am I audible?
Yeah, you're audible.
Hi, thanks for the opportunity. Sir, can you give a breakup of the overall center count now that it has increased by 2, sequentially 2 more centers have been added? Can you give a breakup? How many are in Hyderabad and the rest of AP Telangana?
So, the overall, in the network, we have about 149 centers, Sumit, right? About 127 centers are in Telangana and AP. and the rest of the centers, basically 18 centers in Pune, and we have 2 in Kolkata and 1 in Karnataka and 1 in NCR.
Sure. And sir, regarding this, so Gulbarga is breaking on, right, in this quarter?
Yeah, Gulbarga has break even in this quarter.
Okay. And Ongole, can we expect that to break even this quarter or next quarter?
Yeah, Ongole in the next 2 months, Sumit. It's been 6 months now. In the next 2 months, it's almost closer to break even. So in the next 2 months, we expect Ongole to break even.
Understood. And so, sir, the overall, like the volume growth have been really good. So going forward also for the next 2 to 3 years as you expand, so can we expect more volume growth, or should we expect it to remain at the same level?
So like we always said, Sumit, see, the value growth will be about close to 1.5 to 2%. The rest of the growth would be coming from volume.
No, so the magnitude of volume growth, shall we expect these to remain at the current levels, test volume growth, or should we expect it to increase?
So Sumit, the guidance from the company is that we intend to grow at a 15% year on year, right? Out of which you can expect about close to 13% volume growth and rest the value growth.
Okay, sir. Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. We have the next question from the line of Anshul Agrawal from MK. Please go ahead.
Hi, thank you for the opportunity. Am I audible?
Yes, Anshul.
Great, thanks. So just as a clarification, we have only, in terms of our guidance of hub additions, we have only added Bangalore to the number, right? So we were initially planning to add 12 hubs in 25-26. Now we plan to add 14, which is an inclusion of Bangalore. Would that be correct?
No, I'm sure the guidance was to add 12 hub centers across these 2 financial years, across multiple geographies. So this 12 includes 2 from Bangalore.
Correct. So 3 we have already added, 9 we are adding. 11 is what we'll be adding in the entire of FY'26. I'm just trying to understand that.
No, just let me clarify, I'm sure. 3 we have already added in the current 9-month period. Okay. And 6 more hub centers will be added in the next 3 months. Out of these 6, 2 will come in Pune, 2 will come in Bangalore, 2 in Kolkata. After this, 3 more will come in Kolkata, which will take 6 months from today.
Okay. There's another 2 addition in rest of AP and Telangana.
Yeah. So those 2, the leases are under finalization in AP and Telangana. Okay. Once the lease execution is completed, then we'll start the civil works on those.
2 quarters after.
Yeah, 2 quarters. Most probably that will come in FY'26 itself, but maybe in Q3 of FY'26.
Perfect. Correct. So basically 14 hubs in all in FY'25 and 26 basically.
Yes, right.
Perfect. Great. Thanks. Second question that I had was basically how are we executing so fast in the Bangalore region is what I wanted to understand. I believe in Pune we had an acquisition, and then we took almost 10-11 months to start up the first spoke. But in Bangalore, we are planning to add 2 hubs within 6 months. So is it because we understand the region better? Is the market more lucrative? I just wanted to get your sense around this.
So, Anshul, like we always said, 2 things that are key to this business are people and the right location. When we start with hub, and we need the right location because we are a B2C brand, right? So in Bangalore, we are lucky that we could find the right locations faster. And with whatever experience that we have got from Kolkata and Pune, right, executing the projects, sometimes it will take time because you have to find new vendors where you'll have to undergo the entire procedure of negotiations, etc. With this experience, we worked parallelly when we were looking locations in Bangalore. This helped us, basically executing both the sites faster.
Got it. And would these locations be near to corporate hospital chains or how is it?
No, like we mentioned earlier, we always look at dense residential net, probably a society, affordability, more of medical colleges rather than corporate hospitals. See, we are into diagnostics, OPD facilities where most of our tests have to be done in morning with fasting. So we would rather be closer to a place where our customer lives rather than where customer goes to probably go back for his checkup. So all of our locations in all of these geographies, the base would be more of a residential society in an area. A dense residential network growing around it is what drives us to finalize on a location.
Thank you, ma'am. Our target for break-even in this geography would be similar to Kolkata within 4 quarters?
I would say so, to be a little more conservative since it's a new geography, and like I've mentioned earlier, we're building a team and also elevating people within the team. So I'm just giving it a little bit of time to get comfortable and grow. Not that I think similar to Calcutta would be a good stand to take on this immediately at the moment, since we haven't opened a center in Bangalore.
Perfect. Just one last question, if I can squeeze in. Raju sir, does this materially alter our capex plans for the next 1.5 years? Apart from the two hub additions that we are planning, the PET-CT machine that we have onboarded in Tirupati, how does our capex plan look like for the next year?
So the capex plan will not change materially, Anshul. As we guided earlier, for 12 hub centers, we budgeted 200 crore capex, and we estimate that within 200 crore we'll be able to complete these 12 hub centers. And also we have successfully squeezed in even the Kurnool renovation also, okay, within this 200 crore capex budget. And for a better capital allocation strategy, we have negotiated for a pay-per-use model for the PET-CT that we have installed in the Tirupati. So that will not come under the capex allocation, the PET-CT. So we are able to commission these 12 hubs, including Kurnool renovation, within the 200 crore capex. And the additional 2 regions that we're talking about in AP Telangana, that will be in addition to this 200 crore.
And just to add, Anshul, Kurnool is renovation plus addition of extra MRI. So it's both within the 200 crores.
Got it. Many thanks.
Thanks, Anshul.
Thank you. Ladies and gentlemen, you may press star and 1 if you wish to ask questions. The next question is from the line of Raghav Vednaran from JM Financial. Please go ahead.
Hi, 2 quick questions from my side. One is a broader strategy question on how we decide which markets to enter. Like once we select a geography, say the south, how do we decide in south which places do we target?
So Raghav,
There was no probably choosing of a geography down south. The core geography was always one state, AP, which got separated. So we typically call it core geographies and 2 states. And that's been where we've learned our experience of growing and building up the company. Two is something like we mentioned earlier. We were looking at inorganic growth in certain geographies. And we spent a lot of time, effort on understanding Bengaluru when it came to that inorganic, but I think, finalized on going ahead with PH in Pune. So because of the deep understanding of Bengaluru market and close proximity to Hyderabad, we chose to build out another geography with the addition of the team, and we thought we were ready to take on one more geography, but grow it gradually, organically, rather than take it the inorganic way. That is the reason why Bengaluru happened. Otherwise, it's AP and Telangana down south, and we do not typically look at the other states as of core interest as of the moment, which are probably our Tamil Nadu or Kerala. Those are not of our interest at the moment. Our interest is growing into the east, West Bengal, and Pune, because we were a company and we would have to grow it out and squeeze out the full potential of that company. Raghav?
Yeah. Yes, ma'am.
Yeah. Where did you lose us?
So you had completed saying the strategy of how you all prefer organic and more towards closer to south, and then Sir had started.
Okay, Shiva. Okay.
Yeah. So Raghav, what I was saying is, so if you see Bangalore, right, it's a huge healthcare market. Almost all the large hospital chains in India are present in Bangalore, right? But coming to diagnostics, there is a lot of integrated play, but you have semi-branded chains with 3 to 4 centers each with about 50 to 60 crores of revenue. So there's a lot of demand, but you don't have a single large player. That is where we see the opportunity.
Understood. So, to this, do we see incremental competition in maybe in our core markets or in the new markets from, say, larger hospital chains that do provide in both radio and patho services?
No, Raghav, that's never the case. Generally, we don't directly compete with hospital chains because for a hospital, it's more for captive consumption, right? You, in fact, for multiple reasons, see patients coming out from a hospital for their OP diagnostics for multiple reasons. And the market is not just about this corporate large hospitals. You have boutique hospitals, smaller ones without high-end medical equipment, and then you have a lot of doctor clinics who cannot invest in this kind of technology. So there's a huge market for that.
Understood. Thank you so much. Next question is, do we see any impact on the USD INR depreciation now or going ahead?
Yes, Raghav. We have been monitoring this USD INR. Okay. Unfortunately, the rupee has depreciated to almost close like 87.5. And there can be two impacts, Raghav. One is we procure our reagents and the kits, okay, from reputed vendors like Siemens, Beckman Coulter. Of course, they import it and then they supply it to their Indian arms. Okay, even though our billing is INR, but indirectly we are exposed to these exchange risks. Okay, so even though we have long-term contracts with them, there is a chance that few of the vendors might come to us and then ask for a negotiation. Okay, considering the USD INR going to 87.5. But even if it happens, okay, we'll do a negotiation and then the impact, if any, on the material consumption might be somewhere like 0.2 to 0.3% on material consumption. That is on one side. The second impact can be on the procurement of the radiology equipment, such as MRI and CT. So there is a chance that these equipment suppliers might come back and ask for a revision in the price, considering this USD INR going to 87.5. But okay, we'll have to wait and watch. Okay, I cannot comment any impact on the capex as of now because okay, I hope okay rupee should appreciate okay soon. So the conclusion is the impact, if anything, if it comes on the P&L due to reagents consumption, it can be in the range of like 0.2 to 0.4 because in overall pie, your material consumption for our company ranges between 12 to 13%. Okay, on an average 12.5. Even if you consider a 5% increase, okay, it will come to like a 0.3% impact on the EBITDA side.
Understood, sir. Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, you may press star and one. We have the next question from the line of Sumit Gupta from Centrum. Please go ahead.
Hi. I'm audible. Thanks for the opportunity again. Sir, So USD INR depreciation has been answered. So just wanted to ask, what was the PH EBITDA margin for the quarter? Was it nearly 40%, the trajectory?
So the YTD 9 months period margin was approximately 39%, Sumit. Okay, for the current quarter, it was 36% because of two reasons. One is because of the seasonal impact. The current quarter revenue was 11 crore compared to 12 crore rupees in the Q2. That is one. And there was a one-off expenditure also was there, amounting to like 12 to 13 lakh rupees. Because of this couple of reasons, the Q3 margins were 36%, but the YTD 9 months period margin was 39%.
Okay. And going forward, do you see it increasing? Like, how is the trajectory over the since the acquisition been end? How do you see it panning out over the next 3 to 4 years?
So, Sumit, on the PH-based business, if you see, we are more or less at the 38 to 39% EBITDA margin. But since now the expansion is going to happen in the Pune region, and we are going to come up with larger hubs, and the base revenue is only 45 to 47 crore, with an EBITDA of 40% is close to say 20 crore EBITDA at a year level, right? You may see some margin drop because of these new centers, but otherwise on the base business post acquisition, it is in the range of that 38 to 40%.
Right. Okay, so like when you're expanding, so I want to understand more on the like PH business point of view only. Like how do you see like over the volume growth, like what is the kind of growth that you expect in PH business?
So on the base that we have, you may not see much growth because these are all mature centers, right?
The capacity issue, like we've mentioned earlier, Sumit, these are old centers in terms of infrastructure. They cannot have additional people waiting. Technology is about 8 to 10 years old. So until new centers are added, new additional large centers are added, you will not see an additional growth coming into PH. Until these new centers stabilize and we build a team to probably create a dense network like our co-geography, there will be a dip of 1 to 2% over the next few years till this stabilizes and there's a network that's created in that region.
Understood. Thank you for the answer, ma'am. Thank you.
Yeah.
Thank you. The next question is from the line of Rishi Modi from Marcellus Investment Managers. Please go ahead.
Yeah, hi guys. Am I audible?
Yeah, you're audible.
Yeah. So first, I wanted to understand. You mentioned that the Tirupati hub, you all have put up a PET CT, which is on a pay-per-use model. Now, is this something which is new to the industry where these OEMs are offering a pay-per-use model, or and secondly, if it's something which has been started up, is it available to every player, like say a new player who comes in, or it's for people who have achieved a certain scale or something on those lines? If you just help me understand it.
So, Rishi, this pay-per-use model, if you ask me, is it the first time? No. It is there in the market, but it will not be offered to everyone, okay? Because here, the supplier is taking a risk of deferred credit. Say, for example, the equipment is 10 crore. Under this model, you will keep paying it every month based on a minimum number of cases. Say, for example, like, okay, 8 cases in the first year, okay, they will agree, like next year, like 10 cases, etc. So, it will not be offered to a small player. Okay, Vijaya being the market leader and we have a lot of business with these equipment suppliers, they could offer it at a very at a good inbuilt ROI rate. Okay, so small players cannot get this. Okay, but to answer your question, it is there in the market, pay-per-use model, and generally it doesn't work well for the MRI and CT, Rishi. It works well for the PET CT because the realization, from the patient is close to like a 17,000 to 18,000 rupees from the patient. And then, for a PET CT, generally once you see that ramp up within a period like 4 to 5 years, you see a good EBITDA margins, close to like a 50% margins you enjoy from this machine. So that's how this model is working out well.
So basically, Rishi, see for MRI and CT, even if you take pay-per-use, indirectly it will, it's like taking a loan from a bank. So they'll charge that interest to the equipment when they supply it on pay-per-use. And because we are cash rich, we generally don't take on pay-per-use. Only in this case, PET CT, even the equipment vendor was promoting digital PET. So we got it for a slightly lucrative price. So that is the reason we are trying out. But otherwise, we don't intend to take this model for other equipment.
Okay, understood. All right. Second, I wanted to understand today, like if I look at your FY’25 costs, right? Given that we've done decent double-digit SSG on your centers, normally when we look at other say fixed cost businesses or largely fixed cost businesses, there's a decent operating leverage that comes through when you have such high SSCs, which has not been the case here for us. We've done like 30 bips, 40 bips for the full year in terms of EBITDA margin expansion. So just wanted to understand, are there some costs which have been upfronted here, or is there something where are inefficient and hence going forward we'll be looking at improving the cost structures?
So, Rishi, even in our model, there is scope for operating leverage.
Raju, I think your voice is cracking. Is it just me?
Yeah. So, Rishi, can you hear me now?
It's slightly better. Go ahead.
So, Rishi, even in our cost structure, since there are fixed costs are there, okay, so there is a opportunity for the operating leverage, okay, which played out even in this current quarter. If you see, without PH, our revenues grew by 20% and EBITDA grew by 22%. So the additional, the 2% increment in the EBITDA was due to the operating leverage. Okay, and also, as you know, in this quarter, there is an impact of these 3 new hub additions is there, and also there is a 0.3% impact on account of the new GST regime. Okay, so generally we expect like 3 to 4% on account of operating leverage, but in the current quarter you could see only 2% because of couple of these reasons like new hub centers coming in, and also like a 0.3% on account of the new GST regulation which came in the Q3. And in addition to that,
this new GST regulation, if you could just give some information on that.
So, Rishi, there was a new circular, on GST front applicable from October 1st, 2024, which says that if the company is taking a premises on lease, from an unregistered GST vendor, say for example for 1 lakh rupee monthly rent you have taken, the other party is not liable under GST, even then company has to pay 18% on reverse charge mechanism to the government. So even though we pay them just 1 lakh rupee, we have to pay 18,000 rupees to the government under reverse charge mechanism, which becomes a cost to the company because we are not entitled for an input tax credit on the 18,000. So that becomes a cost in my P&L, which was approximately like a 0.3% in the current quarter.
So, but going forward, like whenever we have leased the property from, I know a lot of it's from individuals, but are we going to get them to get a GST number and hence this 0.3% will go away in the future, or this drag of 18% extra rental cost will remain going forward?
So this drag of this 0.25 to 0.3% will continue, Rishi, but on the overall rental expenditure, close to like 80 to 90% was already built in the GST because most of the property owners are under GST that was already coming in the P&L. Only this 0.3% is only for few property owners who are not under the GST bracket as of now.
Which are the small leases.
Which are the small leases for few spokes.
And also, Rishi, in addition to that, if you see from the past 2 years, we're investing on technology, right? For example, we migrated our servers from physical to cloud. All this also will come up with additional recurring expenditure on monthly basis. So whatever leverage that we were getting because of this growth is at least taking care of the additional expenditure of strengthening IT systems, strengthening the team, all this, right? So that's also one of the reasons why you do not see operating leverage playing out on the EBITDA.
Okay. So, and any startup costs for Bangalore or say Kolkata, Pune, which are sitting here in terms of team or marketing or whatever, which might get spread out as your network densifies. So like basically what is your expectation of margin expansion if your SSGs remain say 10-15% going forward into FY'26?
So for at least 1 year till the time we launch Bangalore, and expand our network in Pune and Kolkata, because we'll be spending on branding and the initial launch marketing activities. For one year, we should not expect any operating leverage playing out. Post 1 year is when, because even by then we will have this network stabilized in these geographies, is when you will start seeing the margins expanding.
Okay. All right. Got it. Thank you. That's it from my end.
Thank you. The next question is from the line of Harish Bihani from Kotak AMC. Please go ahead.
Yeah. Good evening, team.
Hi, Harish. Good evening.
Hi. Ma'am, my question is that in terms, how should one think about business development in terms of hubs addition over and above what we have already announced?
Sorry, Harish? I didn't get your question at all.
I'm saying that in terms of hub addition that we've already announced, over and above that, there'll be some business development that we would be doing in terms of identifying the location.
Yes.
So how should we think about that in specific geography, specific micro market that we are looking at?
Like I mentioned, Harish, I think there's enough on the plate of Bengaluru getting added now, so additional locations there, your Kolkata market plus Pune market and adjacent geographies to these markets is what we would be focusing on. Like we've mentioned, as we speak, there are another 3-4 leases getting signed in one of these geographies at any given point of time. We've still not looked at adjacent geographies for West Bengal or Pune also. So we would be looking at that. So I think every quarter I will be able to give you a better picture on how many more centers would come in, because now we will also be looking at adding additional spokes in Pune once these 3 hubs that we've just mentioned open up, which creates some capacity relieving that will happen in Pune itself.
So Harish, basically in these geographies like Bangalore, Pune and
Kolkata
will continue for scouting locations.
It's not a one-time exercise, Harish. It's a daily, probably, we have multiple schemes even internally. Like if I look at our own core geography of Andhra and Telangana, we have suddenly an incentivization program that we run for our internal staff, saying that, do you feel that there is a requirement of a spoke center in one of the areas that you guys come in from? When we get 20 locations, that's when we also go and look at those locations and see if it makes sense to open a spoke there. So it's just not companies or brokerages that are looking for spaces. It's also our internal team members, customer feedback. On a daily basis, call center gets not less than about 20 calls saying, why don't you open a spoke here? Why don't you open a hub here? These are various ways in which we actually finalize the location. So I think we will probably be zeroing in on the best possible location, and then that's also a reason why we don't let an opportunity go by.
Sure. And you are not putting a cap on any particular number.
Not at all.
Opportunistic
Even
in
though
terms
our
of
CFO
location.
sitting right here and he would say we have a cap on the number of centers, if we look at opportunity from the operational side, we will. We will not. We will say we will do an additional hub, put in additional efforts, open 1 more hub or 5 more spokes, but if it makes sense to us, we will not. We will grow.
Makes sense. And by next quarter, in terms of spokes also, we'll get more clarity.
Yes, absolutely.
In terms of...
Yes, absolutely.
Sure. And in terms of
you put on the presentation are just the ones which were finalized till now.
Yeah, something that's not signed off, we would not want to announce or that's also a reason why we don't announce that number, but you will see an additional number of spokes coming in the next few quarters.
Makes sense. And also by some longer term so that you can grow higher in the longer term. Yeah, essentially, ma'am, what I was trying to understand is that in terms of margins, you think that it's good to sacrifice margins in the near term, about 100-200 bits, so that we can grow in the term.
Yeah. So Hari, basically what we were saying is like, so at a 3-year, near term 3 years, right? So the guidance is that we want to grow at 15% CAGR. But sometimes what may happen is if we find more good locations, we may prepone the capex. We may see higher growth coming in faster. But the commitment from our side is that over a 3-year period from now, we'll grow at 15% CAGR. So now we're closely at say 680 crores. So we are confident that we'll cross 1,000 crore number in the next 3 years to come.
No, sure, Shiva. But in terms of margins, how should one think about it from a medium term and medium?
Yeah. Margins only very near term, maybe 1-2 quarters when we are opening multiple hubs at once, because the timing has come such that we are opening multiple hubs in 2 quarters.
So Harish, I don't think there would be a large impact, maybe a 1-2% impact over the overall period when more of these hubs tend to open at the same time. Otherwise, we're confident of that 40%. But 1-2% of probably you will see a dip when 2 or 3 hubs simultaneously open in 2 or 3 geographies. Couple of quarters.
Makes sense. Makes sense. And, ma'am, in terms of the home market, is there any data point that suggests that we have gained market share? Is the market itself growing in double digits, or is there some data point that can help us understand that we are gaining market share in the home market?
So, Hari, we don't have any data point, but what from the ground, if you basically see Andhra and Telangana, right? So we are growing at a faster pace than the other players. So if you see player number 2 to 10, right? When compared to other players, we are growing at a faster CAGR on this base. So what we feel is that year on year we are gaining market share in our core geographies, but we don't have any number in hand.
And why it happening and why should that continue?
So basically, Harish, I think it is because of multiple things. One, the brand that we have created over years and the dense network. We are available across city, across multiple geographies. So once, like for any brand, right, when it is present across multiple geographies within one state, you tend to get stronger day by day. And also the kind of technologies we invest, no other player in this geography would be able to invest. So it is mix of the talent, like the radiologists, etc., doctors, the brand that we created, the kind of technology we are introducing, it is, and the trust that we have created because of all this. I think this is allowing us to get stronger year on year.
Sure. This is helpful. All the way, guys. Fine.
Thank you. Thank you.
Thank you. The next question is from the line of Surya Narayan Patra from Phillip Capital. Please go ahead.
Yeah, thanks for the opportunity and congrats for the good set of numbers, ma'am. My first question is on the pathology side. So in fact, we have been growing almost in the similar rate like the radiology growth. But in terms of the profitability and all that, from that angle, what I was trying to understand is there a scope of improving the profitability of pathology business, let's say by changing the mix of the test or something like that? Or is anything of that sort can be possible, because the industry nowadays is also kind of moving towards very specialized targeted therapy oriented test. So here, what is our thought process, and whether these kind of initiatives can improve our profitability sometime down the line?
So, Surya, I think nothing immediate on that front, because basically, if you see, since we are a B2C customer, and generally what happens is, specialty testing is more on B2B front. On B2C front, if you see, right, 80% of the business in pathology is about routine and semi-specialized, and very little of specialized. So because as on date in India, if you want to do very high-end specialty work, so basically you'll have to take it from hospitals via B2B route. So I don't think in the near term this would help us anyway in improving the margins.
Okay. Just a added point to the margin aspect. See, we have seen a kind of very stable and strong gross margins for our business over the long period of time now. So, is there any monitorable for gross margin improvement, any factor that can bring in incremental improvement to the gross margin?
So, Surya, we have been consistently delivering the industry-leading gross margins in the range of 87 to 88%, if you see last 7 to 8 quarters. Okay, it's also a combination of how the pathology and the radiology segments are playing around. Okay, like pathology is contributing close to like a 65 or a 64%, and radiology 35 or 36%. Okay, generally, okay, on the radiology front, material consumption is lower as compared to pathology. In case, okay, in the coming quarter, because of opening more hubs, generally what we are seeing is that, okay, when we start a hub initially, the revenue contribution from radiology is generally higher, okay, in the initial couple of years, and slowly the pathology will take over. So in the periods where radiology contribution is more from the new hub centers, there is a possibility of improvement in the gross margin. But Okay? I don't think it will be a material change. It might be like a 0.2 to 0.5% in the overall pie. It might make a difference because of opening like 10 to 12 hubs, okay, in the overall like a 12 months period.
Okay. Just the last one point, sir. What is your now experience after the upgradation of the Gurgaon center? And can Delhi or NCR would be a kind of a area for spreading out of our business there?
Yes, Mr. Surya. So like we've mentioned, Gurgaon was a center that we started a few years ago as a wellness center. And because of its continuous customers coming in from central government and other companies being in a dense residential network, we've only upgraded the facility to be an integrated facility. Putting in an MR into that center was not with the thought process of expanding into the NCR region or Gurgaon or New Delhi. It was the only center in the entire network, which was a center which spanned over about 8,000 square feet with only ultrasound and wellness. And we wanted to make it integrated in nature, and it's doing reasonably well. And there's no absolute strategy around that in terms of growing in that particular geography. It is an old center, it's a mature center, and we've upgraded it to keep in pace with what we keep our centers in our core geographies. That's the only thing. There's nothing more that we would be doing in the Gurgaon center.
Sure. Yeah. Thank you, ma'am.
Thank you.
Thank you. The next question is from the line of Abin Benny from MK Global. Please go ahead.
Hi, thank you for the opportunity. So just wanted to understand that given the wellness segment has been robust with around 14% contribution to the top line, what would be the outlook for this segment for Q4, given that we would assume largely that people would be going for such packages in this quarter for the health benefit claims and everything? If you could just highlight a bit on that.
So basically, post-COVID, what we have seen is, the awareness has basically gone up, right, on the preventive packages. And also we have a team, corporate marketing team, who will approach corporates for their wellness. So because of these efforts, you are seeing the wellness grow. But as such, we cannot guide exactly on the wellness because it's again preventive in nature. But generally, what we have seen in the past is in Q4 was always wellness. The wellness revenue is slightly higher in Q4. So we expect the same thing to happen in this year as well. But we cannot guide you on any number.
Doing exceptionally well this year because pre-COVID it used to be around 8 to 9%, which has gradually grown over the years with customer probably awareness. You're doing about 12 to 14% on a base of our size is itself a very large number. And typically you tend to look at the last quarter for tax exemptions and a lot of other schemes coming in from corporates. But saying so, that 13 to 14% itself is a very large base. So probably we would not be able to guide you exactly on a number, but even if we do that number, I think that would be an exceptional number to keep going for the next few quarters to come.
Got it, ma'am. If you could just mention about what's the net cash position right now?
1 second, I'll let Raju get it.
It's approximately about 200 crores surplus cash treasury balance we are having, Benny.
Okay, sir. Thank you very much.
Thank you.
Thank you. The next question is from the line of Rahul Jeewani from IIFL Securities Limited. Please go ahead.
Yeah, thanks for taking my question. Hope I am audible.
You are audible, sir.
Yes, Rahul.
Yeah. So, ma'am, in terms of the growth outlook which we provided for the business from a 3-year perspective, in terms of 13% volume growth and 2% realization growth, leading to mid-teens overall revenue growth, do you think there is some sort of a conservatism built in those numbers, given the fact that the number of hub additions now for us are significantly higher than what we used to do in the past? So if we look at FY'22 to 24, we added only 7 new hubs, and now we are talking about potentially adding 12 new hubs over a period of 15 months. So with the kind of hub additions which we are seeing, would our growth be higher than mid-teens for what you are guiding?
So Rahul, basically, see, what we believe is in sustainable.
7 hubs were in the core geographies, and all of these hubs that we're talking about, like I've mentioned, 2 hubs each in Bengaluru, 2 in Pune, 2 in West Bengal. If you look at that, see, PH, of course, is an old brand built on trust, has a clientele, known company. But Bengaluru is an absolutely new slate for us. And again, West Bengal, we've started off with a Vijaya brand, 1 center, BIP Road, and then you're looking at 2 new. So if you would say we are being a little conservative, yes. But the 7 hubs that you looked at and the growth is from the core geography versus 2 of new geographies. So we are guiding you accordingly. But does not mean that probably we will give you that 13 plus 2 is not what we're saying. We're guiding you on those numbers to make sure that we overachieve and probably do well. But these are different geographies and I would not have a base number to give you a firm commitment on. That's the only thing here.
Sure, ma'am. And in terms of, let's say, scaling up in some of these new markets like Bangalore, in the past when we added this new hub lab in Calcutta, we were able to achieve EBITDA break-even within a 12-month period. So do you think that the EBITDA break-even for some of these newer hub centers?
Absolutely. I would say yes for both Bengaluru and the PH new centers. Is 1 year is a good year time period to consider.
Sure, ma'am. And just one bookkeeping question from my end, sir. Can you talk about your pre-Ind AS EBITDA margins as well for the 9-month period?
EBITDA margin.
Yeah. So Rahul, the pre-Ind AS margins are close to 33.5%. Okay, because the rent component is close to 6.5%. So currently the Ind AS margins are 40%. So pre-Ind AS will be 33.5%.
Okay.
Also, Rahul, even on there's a positive impact on the PAT side as well. Currently, you have seen that the PAT margins are close to 21%, 20.9%. Even the PAT margins will be improved by at least like 1% if you consider the pre-Ind AS. So instead of 21, it will be 22% will be the profit margin if you consider pre-Ind AS.
Okay, sure, sir. So 6.5% impact at an EBITDA level and 100 basis point positive impact will be there at the PAT level.
Yes, that's correct.
Okay. Yeah, thank you, sir. That's it from my side.
Thanks, sir.
Thank you. Ladies and gentlemen, as we have no further questions, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
I would like to thank everyone for attending this call. Should you need any further clarifications or any other further information from the company, please feel free to reach out to us. Thank you.
Thank you. On behalf of JM Financial, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.